Berkshire Hathaway is sitting on $276 billion in cash. That number is not a cushion. It is a position. That reading is wrong. Buffett is not waiting. He is positioning, and the distinction carries roughly $276 billion in weight. Berkshire's cash-to-market cap ratio sits between 28 and 30%, a proportion not seen in decades. This is not capital at rest. $276 billion in liquid reserves is strategic optionality at a scale that can move markets. The conventional read misses the signal entirely. The cash itself is the verdict. Buffett is not waiting. He is judging. That $276 billion was not a slow accumulation. It was the direct output of deliberate, large-scale divestiture. Through 2024, Buffett significantly reduced Berkshire's position in Apple, a major equity holding within the firm's portfolio. He did this while the S&P 500 was printing all-time highs. Buffett sold into strength, not out of distress. That distinction is the entire story. Selling at peak valuations with no fundamental breakdown in Apple's business to justify the exit. The position was exited because the price no longer met Buffett's required rate of return threshold, not sentiment, not macro fear, a arithmetic conclusion. The cash pile is not a liquidity accident. It is the residue of a valuation judgment executed at scale. When the greatest capital allocator of the modern era converts an equity holding into cash at all-time highs, he is not waiting for a better moment to buy. He is saying formally and publicly that current prices do not offer adequate return. The divestiture made that verdict concrete. The Apple exit is the clearest evidence in this story. Not a hedge, not a rotation, a conclusion. Buffett put his valuation framework on the record in Berkshire's 2024 shareholder communications. That framework centers on a required rate of return threshold, a hurdle every prospective investment must clear before capital is deployed. That is not a hedge. It is a formal verdict, entered publicly in writing through the shareholder communications Berkshire files for the world to read. The S&P 500 reached all-time highs through 2024. CAPE ratios sat at historically elevated levels. Credit spreads were compressed. These conditions feed directly into Buffett's framework. Intrinsic value against long-duration return expectations. At current prices, the math does not clear. Most of the market is pricing for outcomes that Buffett's analysis does not support. That divergence is not noise. It is a documented disagreement between the market's collective pricing and the return calculus of the most closely watched capital allocator in modern history. While cash accumulated to $276 billion, Berkshire was simultaneously buying back its own shares at a record pace. On the surface, that looks like a contradiction. Building cash while deploying capital into equity. It is not a contradiction. It is a relative value judgment. Buffett found one equity that met his required rate of return threshold. Berkshire itself. Every other equity in the market failed that threshold. Not selectively, categorically. That is the structural signal embedded in the buyback. Passive cash hoarding requires no view on value. Buying back Berkshire, while refusing external equities, requires a precise one. Capital is being deployed. It is being deployed in exactly one place. That place tells you everything about how Buffett prices the rest. The question is not whether Buffett deploys this capital. Historical pattern makes that answer clear. The question is, what conditions trigger deployment at this scale? Buffett moves into dislocated markets, not before them. Historical pattern shows how Buffett has deployed capital in prior dislocations. In 2008, as credit markets seized, Berkshire moved capital into distressed positions, finding prices that cleared his required return threshold precisely because the broader market had broken. That is the deployment model, not anticipation. Dislocation first, capital second. The $276 billion sitting in reserves right now is not positioned for a gradual softening. It is positioned for a break. $276 billion entering a corrected equity market would represent a substantial single-cycle capital deployment, one with the potential to reshape valuations across multiple sectors simultaneously. Markets are now pricing two variables simultaneously: Buffett's implicit valuation ceiling on current equity prices and the size of the bid waiting beneath them. When the most closely watched capital allocator in modern history holds maximum cash at all-time highs, that is a signal, and Buffett has been precise about when he sends it. A 28 to 30% cash-to-market cap ratio is not a posture of caution. It is a standing, public, documented statement that current equity prices do not offer adequate long-duration returns, issued by the greatest capital allocator of the modern era at all-time highs. Institutional allocators and macro strategists now have a live reference point inside the market structure itself. $276 billion stationary is an implicit ceiling, a valuation threshold the market has not yet cleared. When valuations correct to a threshold, Buffett's framework can clear. $276 billion enters the market. That is not a forecast. It is the only logical consequence of everything Berkshire has put on the record.